Hi value investors, welcome to my channel Value Investing Apply. Today I'm going to talk about intrinsic value of Apple. I will present to you all the spreadsheet in Excel in which I'm including all the assumptions that I'm making in order to make projections for the next 10 years and then to calculate the fair value of this amazing company using the DCF, the discounted cash flow methodology. So you know that there are certain analysts who are saying that this is a company that could reach the $200 per share. But there are other analysts with a more bearish sentiment who were saying that this is a company that just could reach at least, well, at most $120, $130 per share. So in the purpose of this video is to find out what is the assumptions that these analysts are putting in their models in order to calculate the respective intrinsic models, and we will find out what are the assumptions really that really make us feel comfortable with intrinsic value that we will get at the end of this video. The thing is that we are getting really in a really difficult scenario in which the Federal Reserve is planning to make interest rate hikes for the rest of the year 2022 and most likely in the year 2023 as well. So that creates a scenario in which we need to stick to companies that have strong business models, and Apple is just one of them. So I will start presenting all the spreadsheet in order to calculate what could be that fair value that we want to find in order to establish a benchmark for our future decisions respect to this company. So we will start right now. Okay, now we have this data. This data, I have collected this data from the SEC documents, from the 10K, the annual reports of the company. And well, the first thing that you will see here is that what is the participation of each of the products over total sales. So here, for example, in the year 2017, we have 61% over total sales respect to the iPhone. In the case of the iMac, 11%. It represents 11% over total sales and so forth. But you can see how this concentration in the iPhone has been declining over the last 5 years, so which is something really good because we don't want our company to just rely on just one product. Okay, but something interesting is how this company, since 2017, the wearable home and accessories and services, both business lines, have enjoyed a 20% over total sales in 2017, and now these both business lines have enjoyed the almost 30% and represent almost 30% of our total sales in the year 2021. Okay, which indicates, of course, that the management has put so much emphasis in both business lines because they, of course, contribute to a higher net margins in the company, and of course with a higher free cash flow of the company. So this is something interesting. I will want to comment what is the strategy here in order to make the projections. But before that, I want just to make a comment that probably I just don't need to consider all these numbers because, well, if we would just focus on the free cash flow from the SEC documents, you can just I can just have consider a growth rate for the future, and in that way I would have been able to calculate the projections for the next 10 years and perpetuity and calculate finally the intrinsic value. But the problem with that more simplistic model could be the fact that we don't know what could be the growth rate for the sales. So that's the thing that I wanted to make in this model of Excel really different. Here we are trying to link the projections for the sales, and then we will try to link all those sales to the calculation of the free cash flow. So the free cash flow here will be a result of our previous assumptions in sales. So that's something that is really different because we can make more, I don't know if more precise assumptions respect to the sales, but of course we will know if those assumptions made in each of the business products, how they could have an impact in the final intrinsic value that we will calculate at the end of the video. Okay, now The thing here is that we will start with the iPhone and with the iMac and with the iPads. You know that these products has experienced a growth in the last year, really good growth in the year 2021. But of course, in the year 2018, well, in the case of the iPhone, it was just 18%, minus 14%, minus 3%, and then 39%. The same thing happened with the iMac, something really similar, and in the case of the iPad as well, the year 2021 was outstanding. Okay. Now we need to understand how Apple was able to deliver this kind of growth. We need to understand that in the year 2020, you know that there was this package of stimulus from the U.S. Because in order to face a potential liquidity crisis because of COVID, because of all the restrictions, because the lockdowns and so forth. So as a result, of course, the Federal Reserve and the U.S. government were putting more money into the economy, and more people had more money in their pockets. So that, of course, give them the incentives to the people to buy more goods and services. And among all those products, Apple's devices were one of them. So this is something that we need to consider. So it is, if you are planning to make a projection for the next 10 years, I mean, I won't consider any sort of future package of stimulus, because of course the result of that package of stimulus was the inflation rate in the US of 7% approximately. So I don't think so that there could be the same event in the following years. So here the thing is that I will be, of course, really more conservative. But anyway, after reading some learning articles related to the iPhone really is facing a huge catalyzer anyway, because you need to understand that we are getting into a new cycle in the iPhones respect to the 5G network, and I should say that the iPhone really is taking the lead in the market. This is a device, the iPhone, that is including this 5G network, is really well demanded and well appreciated by the consumers. So this could be really an important catalyzer for the next years. So I am considering here for the iPhone something like 5%. Well, we could change that assumption in order to see how the intrinsic value just change with all these changes. But I'm considering the first place 5% for the iPhone. Okay. And of course, you shouldn't forget the fact that there are wireless carriers like AT&T, Verizon, and so forth, and all these carriers are pushing the sales of the smartphones, including the 5G network, because of course these carriers have invested an enormous amount of money in the last years. So they will need to recover all that money and pushing the sales of these smartphones, including this new 5G network. Okay. Something important here would be respect to the Mac and the iPad. You need to remember that Apple has developed its own chips in the year 2020 and 2021, and all these chips are included in these new devices. So this really is a truly added value services for the consumers. The consumers are demanding more these iMacs and iPads because of these added value services that Apple is including within inside its devices. So I would say that there is the possibility that Apple launch more sophisticated or more advanced chips in the future, and that of course could be future catalyzers for to push up the sales of these new devices, So this I will consider just 5% here for in the case of the iMac and the iPad, and I will maintain this growth for the next 10 years, okay, for each of these products. Now we have these wearable home accessories and services, which even before the pandemic they were enjoying really a double-digit growth. So I don't feel any bad to consider that these both business lines could grow at a 15% rate for the next years. Okay. And that is something important because these, both the wearable home accessories and all other services, really contribute to reinforce the Apple's ecosystem, which of course generates the stickiness of the consumers to the Apple's devices. So this is really interesting to consider here. And well, once we have all these assumptions, okay, we can make projections for the total sales. This is total sales, of course, by product, but then we can just sum all of them here, and we have the total sales projected. Okay, these ratios are the growth of the total sales projected from 2022 respect to the 2021 and so on. Okay, now here we have, once we have these revenues, we can estimate we can estimate the cost of sale for our projections. So the trick here that I just made is the fact that we can divide all the total cost of sales average by the average of the total sales, and in that way I will find a new percentage, and this is the percentage in which, well, the total cost represent 60.9% of the total sales. So I will apply the same percentage for our projections. So given the fact that we have already made a calculation for the projected sale, we could just apply the total cost here and calculate the total cost of sales. In that way, once we have that, we just could find the gross margin, okay, just subtracting, okay. Of course, if you don't feel comfortable, you can just increase this percentage if you consider that the inflation rate could push up the total cost of sale for the future. But of course, given the fact that we are talking about a company that is really strong, that enjoys a really strong competitive advantages, well, the company really can set higher prices. So the company honestly can transfer the higher cost to the sales to the end customer. So I will consider that this is something that is constant over the years. Okay. Now the same strategy I will apply to the R&D expenses and to the general and administrative expenses of the company. Just dividing the average of these items in the last 5 years respect to the average of the total sales. Okay. So we have these projections for both items, for both expenses, and then we will just sum each of them, and in that way we will find the operating income just subtracting the gross margin minus the total operating expenses here. Okay, this is something interesting because we are just using the total sales projected as the source of our projections. We just need to calculate this percentage, the percentage, and just multiply it by the total sales in order to make the projections of each of the items of this income statement. Okay. Now, once we have the operating income, we just need to calculate the other income item, the same thing under the same strategy here, and we will have the income before provision for income taxes, okay, which is basically the operating income plus the other income here. And I'm just following the construction in the financial reports of Apple. And this is really relatively easy really to find with this trick to make projections, but honestly these projections work well with strong companies, with companies with strong competitive advantages, not with cyclical companies. So I will avoid to use these kind of methodologies in cyclical companies or companies that have many problems in their respective industries. Okay, so the thing here is that we have the net income here. It is just the income before provision for income taxes minus the provision for income taxes here. Okay, so finally we have the net income that we want to calculate here, and the only thing here is how we could calculate the free cash flow. Okay, now this is the period, the data. I mean, this is the years 2017 to 2021, and here we need to apply certain things in order to get the free cash flow. Here, for example, we have the net income, and we just need to add. The first thing what we need to calculate is the cash flow from operating activities, because the free cash flow is just the cash flow from operating activities minus the capital expenditures. So the first thing that we need to do is really to calculate the cash flow from operating activities. And in order to do that, we need to include here all the depreciation, amortization, share-based compensation, variation of working capital, so on, all these non-cash items, and those will be added to the net income in order to eliminate all those non-cash items. This is something that I just explained in my first video, okay? And then we will just sum up all of these non-cash items, and once we have that, we could obtain the cash from operating activities, which is the net income plus all these things, all these non-cash items. In that way, we are getting the cash, all the inflows and outflows as a result of the operations of the company, which is something that in which we are interested. So here we have the cash flow from operating activities, and well, the strategy here is just to apply the same thing that we just applied before, just taking this total depreciation, amortization, share-based compensation, and in average, just divide by the average of total sales, okay? And we just apply this total depreciation, amortization, multiplying by the projected sales, okay? And in that way, we could find out what could be all those non-cash items, which will depend in our case by the revenues, okay? The revenues projected, the sales projected, okay? Now the thing, once we have that, we can just add the net income to the total to all these non-cash items, and then we will have, well, we will make the projections in the same, applying the same strategy here, using this strategy, just calculating the average of the capital expenditures and divided by the total sales, average total sales, and we will apply that percentage to the sales projected here, okay? Now once we have that, we can finally find the free cash flow of the company here for the next 10 years here, or 9 years, I think, well, 9 years here, and then, well, we could proceed to calculate the valuation of the company here, okay? Now, in order to calculate the present value of all these cash flow, we need to calculate the present value for all these cash flow. I mean, there are 9 years, and then for the perpetuity, because of course we need to estimate that a company like Apple will thrive, will operate beyond 10 years, okay? So here, the thing that I will need to assume is that, well, we are assuming that in the year 2031, we will get a growth respect to the previous one, to the year 2030, of 1% in free cash flow, okay? So in order to calculate the present value of all these future cash flow here, we will need to apply a formula which is called the perpetuity. Okay, in order to apply the perpetuity here, we just need the first term from the year 2031, and then, well, we will need to divide by the subtraction of the cost of opportunity minus the growth, the 1%, which is the growth that we're estimating for each of the subsequent years, okay, in a perpetuity here, okay? This is something that I just explained in the first video. You can check it out if you want to know more about that, okay? And this is the present value, because the present value is located here 1 year before. This is the present value of all these sequence, okay? This infinite sequence, okay? Now, but in order to calculate really the present value of this number, well, we are here. We could consider that we are at the end of the year 2021. So here we can calculate. We need to again to calculate the present value of this present value. I mean, this is redundant, but this is something that is important to do, because really we are here, so we need to calculate the present value because we are in the year at the end of the year 2021, or we can consider the same thing at the beginning of the year 2022. Okay. Now, in order to calculate this present value, we just need to take this number and divide it 1 plus the cost of opportunity at a 9 exponent 9, because we are in the year 9. If we were in the year 5, here, well, we need to, the present value would be at the exponent 5. Okay. Now this is the present value of the perpetuity here. Okay. Perpetuity, and this is the present value for the 9 years, for these 9 years here. Unfortunately for us, the Excel allow us to make this, to apply this formula in which the only requirements are the cost of opportunity, and just select all these cash flow, and Excel calculate for you the present value from the year 2022 to 2030. Okay. I mean, okay. Well, we need to take into account that we are, I mean, if you are using the DCF, really, we need to think that we are acquiring the 100% of the shares. So if you are really buying the entire company, it's because, well, you will need to pay for the debt. This is the first thing, and the debt for the company is 91.8 billion. And the cash in hand, which includes the cash in hand in its savings account, which is located in the balance sheet, and 27.6 billion, which is the marketable securities that could be transformed so fast in liquidity, and that's the reason why I'm including that as a cash or liquidity. Okay, the liquidity that we will get access once we acquire the entire company. This is the assumption behind the DCF. Okay, so once we have all of that, we just need to sum all the present value, okay, of the perpetuity and the present value of the next 9 years. We need to subtract the total debt and add the cash in hand as part of the valuation. Okay, and then we have the intrinsic value just divided by the outstanding share, which is a number that you could find in the 10K document of the company, okay, in the SEC. Now, apparently, well, with this 144, most likely you would think that this is a company that is overvalued, because right now we are something like 170, okay. Particularly because of the good results that the company had for the first quarter in 2022. Okay, so apparently here, according to just this, all this data, you can think that the company is rather is overvalued, and there are of course some analysts who probably have more bearish sentiment, and could just include that, or could say that the growth of the iPhone really could be 1%, okay, or the growth of the iPad could be of the iMac 1%, and look at how the intrinsic value just changed to go down, basically because you are more bearish in your assumptions. But given the fact that we know really better about the projections, I mean about the catalyzer of this company for the future, I would consider that this is, I feel comfortable with this growth, okay, for the next 10 years. Now, what is the important thing here? That we are not considering potential future catalyzers in respect to other products, and that's why I made projections for the augmented reality and virtual reality products, which is of course the products that could be used for the metaverse. Okay, now the thing is that this is just certain assumptions that I just made. based on the assumptions of certain analysts in Seeking Alpha, and in other, I read other articles, other assessments with respect to Apple about the rumors that these kind of products will be launched in the year 2023. Of course, we're not sure about that because it is not official, but of course, it could be a potential catalyzer, of course. So we will see a little bit deeper here. Now, the growth rate by year for these products is 43%. It is estimated at 43%, with a price an average of $2,000 per unit. Okay. Another important point, well, is the fact that it is estimated in the year 2023 there could be sales for up to 3 million of units. Okay, so if we multiply this number of units by the average price of these new products, well, you will get something like 6 billion in the year 2023. And taking into consideration that these units sold are growing at a pace of 43%, their revenues are growing at a 8.5 billion in 2024, 12.2 billion in the year 2025, and so forth. So in order for us to include these potential catalyzer in our calculation of Apple, calculation of the intrinsic value of Apple, we need to find out what is the contribution in terms of free cash flow that this product will generate. In order to do that, I mean, I don't know honestly any sort of information with respect to the cost related to these products. So I really wanted to make certain assumptions here. We know that, for example, in the case of the entire company, Apple, the company has generated since 2017 to 2021 and a generation of cash flow respect to its revenues of 24%, which means that the company Apple has been able to generate by $1 of revenues 24 cents of free cash flow, which is really good. I got to say this, but well, we don't know what could be the generation in the case of these augmented reality and virtual reality products. So I just consider that this is almost equal. Okay, equal. This is the rate at which these products will be able to generate cash flow. I will keep it the same. We could consider that this could be 12%, just half, but I don't think so. That honestly, that a guy like Tim Cook, which is a master of the supply chain management, will allow that one of its new products will produce so few cash flow, okay, that could of course damage the total cash flow of its company. I don't think so, honestly. So he will of course make adjustments in order to push the efficiency and the efficacy in the production of these new products. So I'm assuming here that it will be maintain this ratio. Okay, so we are saying basically that this new product will be able to generate by $1 of revenues, it will generate 24 cents of free cash flow. Okay, now just applying that formula, we just need to multiply these revenues by this percentage, and you will get your desired free cash flow for each of the free cash flow here. This is an assumption, of course, and we need to be really conservative here. And then with the perpetuity here, I'm just considering that, well, in the perpetuity since 2031, this growth will be just 6% and not the 43%. Okay. Now we just calculate the perpetuity here as we have done in the previous calculation of the intrinsic value of Apple. Okay. And the thing is that we just need to take back, and I mean, this is the present value of the future cash flow generations here, and then we will need to bring back again to our present value because we are here. Okay, and well, this is the present value of the perpetuity, and this is the present value of all these cash flows that this new product will generate for the next 9 years. Okay, then we just add up both the numbers, and then we could proceed to include this new number here. If what happened if the, well what happened if you include that, well, you can have intrinsic value per share of $202 per share. Okay, and here we are not considering the potential generation of value of the electrical vehicle. But the thing is that I don't know anything about that project, because, well, the company, the management in general, has advanced this project secretly. So honestly, we don't have so much information. There's no official information about it. So honestly, I wouldn't include anything. I'm sure that some analysts are including this kind of information, probably taking the business model of Tesla in order to calculate what could be the potential calculate the potential generation of free cash flow and growth in sales for the future. But we are talking about this is a really difficult, because to know that really. So I'm not including. I prefer to be really conservative and not include anything here. In fact, I wouldn't consider anything as well here, because we don't know what could happen in the future. Respect to these augmented reality and virtual reality products. And so for me, well, I'm just considering here that the intrinsic value per share is 144, and I would expect further corrections in order to take advantage of these valuations. Okay, I would like to, of course, to pay. I would like to pay more a price below 144 if it's possible. If it's not possible, well, I just would continuously wait for that price. But of course, I cannot say anything if you consider that this is an intrinsic value that could be, $202 per share. It is feasible. It is really feasible, because we're talking about a management. A team could really deserve great credit, because since he has taken over his position as a CEO in 2010, while he has made an incredible work with Apple, rewarding so much its shareholders. So it is possible here. Now, even if we are really bearish about this company, we have another driver that we could consider here. And well, what happens even if you have a really bad sentiment or really bearish sentiment against Apple? You won't consider all those catalyzers that I just mentioned. But look at this. This is the intrinsic value in a scenario in which we are not considering any valuation for future catalyzers here. Okay, just considering the current all the catalyzers of the current products. Okay, now what happens if you just take that valuation, 2.4 trillion, and then, well, we know that Apple dedicate or allocate an important amount of money, an important percentage of its free cash flow in repurchasing its own shares, and that by its own is really a really strong driver for pushing up the intrinsic value of the company for the several years. Here we have, for example, the outstanding shares in the year 2020, 2021, and just assuming that the company is buying each year 3% of its outstanding shares for the next years, the company is reducing the amount of outstanding shares in the market, and in that way, assuming that we are maintaining this valuation for the same year, for all these periods. So just keeping this 2.4 trillion for the next 8 years, you can see how the intrinsic value is going up just because of the purchases of its own shares. And look at this. That's amazing, because the company has the resources, has the cash, and that is part all that cash is generated thanks to its to the loyalty of its customer, to the culture that the culture of innovation that this company has, and so forth. So really, even if you are in a bearish sentiment, you need to consider this part. really. So I think that you have lots of things to win. Of course, there's not the same thing that you buy this company at 170 that you have the possibility to have bought this company at 120. It's completely different, because those who were buying this company at a lower price, there will be all those investors will have a better long-term return of their investment. So this is the kind of things that I want to share with you. Please consider to put a like to this video if you think that this is a video that could add value to your investment decisions. Don't forget that this is not a financial advice. This is just for educational purposes. This is just the first part of this video, the first part of Apple's case. I am planning to make a second part very soon. So I hope that you really have enjoyed this. Please consider to subscribe. It's just for free, and you are supporting this channel and giving incentives to continuously delivering more and more value from different companies. Assessment. So I hope that you really enjoy this. So I will see you in the next video. Peace.